Like the NBA champs, the Boston Celtics, mortgage-backed securities have become the talk of the town. So why are MBS being seen as an investment opportunity right now? Is it a trend, or is there more longevity to this story? We're going to break it all down for you right now on UBS Trending. Hey everybody, welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. My guest in the studio is Clayton Trick, Head of Portfolio Management of Public Strategies at Angel Oak Capital Advisors. Clayton, good to have you in the studio with us.
Anthony, great to see you.
So, mortgage-backed securities, it's a really interesting story. And just to kind of give us a little quick look at our view here at UBS, our Chief Investment Office also has a most preferred on agency mortgage-backed securities. So let's just kind of start from the top. Why are they turning heads right now, and what is your view on MBS right now?
Yeah, Anthony, we have a very similar view, actually, to Leslie Falcone in the agency mortgage space, and the mortgage space in general.
Yeah.
It's been quite an evolution for the opportunity set in mortgages. In the last 24 months have been nothing short of fascinating. Overall, the Fed has reduced their balance sheet, and they were one of the largest holders of the agency mortgage market. Banks also were a large holder. And so with this rise in rates, it's created a huge opportunity in the agency mortgage market. At the same time, spreads have done pretty well. Equities are a lot higher. Corporate credit spreads have tightened in pretty significantly. But agency mortgage spreads have kind of hung out at much wider levels. And there's a series of factors that really play into that.
Yeah. And just for our viewers, not everybody knows what an MBS is. It's a share in a bundle of home loans and other real estate debt. So, and then, it acts kind of like a bond where, the investor will get, a coupon or an, interest on that loan. So that being said, is it tied, or it should say the success or the investment recommendation that you and CIO have, is it tied to mortgage rates? Because as we know, rates have really skyrocketed for 30-year fixed mortgage rates. They topped out at something like 8.5% a few months back. Is it tied to that, or is it something else?
It's really just how quickly interest rates changed. So interest rates coming after COVID, the Fed lowered rates significantly, pretty much to zero. And then as inflation surprised to the upside, the Fed had to effectively cool the economy.
Right.
So they raised rates very rapidly. So mortgage rates for mortgage holders in 2021 was averaging 2.5% to 3.5%. As interest rates rose sharply to that 7% to 8% number, Anthony, that you were quoting, that created a huge opportunity in the agency mortgage market where now investors can extract those higher yields. The biggest difference, though, is really the buyer base. And so as interest rates increased, the Fed, as part of their QE program, has been reducing their allocation to mortgages, and they're effectively a non-economic buyer. So they were buying mortgages just as part of supporting the economy after COVID.
Yeah.
So as rates are rising, they're reducing their balance sheet. The banking system, when rates rose, really got hit by the increase in rates. That's what we saw with SVB out west. It happened to the entire banking system. And so you created this huge gap in the market for the primary buyer base of agency mortgages. And so now that gap is being filled by other investors. And those other investors have higher yield return goals, higher return hurdles. And so now investors can access those markets at much higher yields, basically because rates rose so quickly.
Right. I mean, because truth be told, you look at the MBS market, and it had struggled versus some other high-quality counterparts up until, like we were saying, last year or so,
Absolutely.
when we did see that fluctuation in rates. So it's a really interesting market to look at. On the flip side, there's other financial instruments that are out there. Home equity lines of credit, which is exactly that. People get second mortgages, and I think a lot of folks, including myself, were in our apartments or homes for so long during COVID. I looked around and said, it's all got to change. So let's get a home equity line of credit, do some renovations, change some things. So they became extremely popular. We heard, you look at home renovations by percentage, and they spiked after COVID. So those are also financial instruments that you're tracking as well.
Yeah, absolutely. We actually expect huge growth in the home equity line space, in the second lien space. And that's really just been driven because home prices have increased so much, but debt hasn't really increased. Leading into the financial crisis, debt increased, people were refining their first liens. Now, the majority of mortgage holders, their first lien mortgage is below 4% still.
Right.
Even if you get a new mortgage today, it's around 7%. So there's this huge gap of you can take out a second lien, take on a home equity line, and utilize that to do the renovation, to invest. You can overall access your home for liquidity, and we haven't actually seen borrowers do that to much of an extent. The actual loan to value of the U.S. housing market is at a 50-year low, and so that you're now going to see a lot of home equity lines and second liens come to the market for borrowers to be able to access. From a bondholder perspective, those are really interesting assets. The fundamentals of the housing market are in really good shape as far as lending to that market, and if you think about where the yields are, HELOCs are yielding 10 to sometimes 14% in an asset that we think is really, really attractive as far as backing the U.S. home. And so there's a lot of cushion overall in the U.S. housing market. There's a lot of money that's probably going to be extracted over the coming years. If you look at home equity today, it's around $30 trillion, an all-time high. And so again, it's very different than leading into '08, where you had this rise in home equity, but it was created by kind of a debt-fueled bubble. This time, it's just because everyone said after COVID, hey, I'm going to move out of my apartment, potentially buy a house. It pushed up home prices when the market couldn't create enough homes at that time. So home equity has risen significantly, and now you're going to see borrowers access that home equity, and then also from bondholders can now buy those assets.
Right. And if you're somebody who's in your home for a few years and you've got like a 3.75%, 4% 30-year fixed rate, you're probably not going to be as likely to buy a new home if you have to get a 7.5% mortgage rate. So staying in your home and doing renovations, whether it's a home equity line of credit or a second lien, seems to make sense economically speaking.
Yeah.
For most families.
It's pretty simple, like dollars and cents. And so you've seen the data where housing velocity, housing turnover is at a 30-year low because people are sitting in these low mortgage rates, and so they're deciding to access other areas of debt, be it an auto loan, a credit card receivable.
Right.
The home equity second lien market is still in its infancy. We're only seeing, in our view, like the second, third inning of that market. I think there's going to be huge growth in the home equity and second lien market over the next 5 to 10 years, which is good for housing. It actually could contribute to that soft landing potential over the next 18 months as consumers can access areas within their home to continue to spend. And then on the bondholder side, it's an attractive asset for us to own fundamentally.
Right. And that was going to be my question for you as we're wrapping up here. We're looking at the Fed. We're expecting possibly one cut this year, according to the dot plot. And we've been talking about this ad nauseum for the last week or so. And maybe 4 cuts next year. Who knows? But does that come into play when you consider the recommendation of mortgage-backed securities, for example, knowing that there is a chance that the Fed is going to really start cutting?
Yeah, so overall, it's very difficult to predict when the Fed's going to cut.
Of course.
There's a higher probability that if they hold off on cuts this year, only do 1 or 0 cuts, they could cut more next year. What we do know is that real rates are high. Basically, they're keeping rates at a restrictive level, inflation's coming down. That means that at some point in the future, most likely rates are going to fall. So investors can take advantage of that, extend duration, buy mortgages with duration, and kind of lock that in. We've really been recommending investors getting out of cash, putting that money to work, and you don't know the timing of it, but you do know that if you buy a high-quality, attractive asset on the belly of the curve, it's probably going to work out well, especially if you're buying it at a discount.
Right.
And so we see investors taking advantage of that, not knowing the exact timing of Fed cuts, but we do know the Fed is at a restrictive level, and so eventually those cuts are most likely coming.
Right. As our own Leslie Falconio says, cash does have a place, but it shouldn't be everything. I mean, considering the rates that somebody might be getting on their money market cash right now, it's very attractive, but that won't last forever. So got to put that money to work.
Absolutely.
Right. Clayton, thanks very much, my friend. Thanks for coming through, and good to see you.
Thanks, Anthony.
Great.
See you again.
Okay, see you soon. Clayton Trick again from Angel Oak Capital Advisors. And for more information on anything coming out of our Chief Investment Office or our great partners like Angel Oak, you can visit our website at ubs.com/views. Plus, we're all over social media. We've got content on all the major channels, including Instagram. You can give us a follow at UBS Trending for studios content you're not going to find anywhere else. And as always, if you have any questions about what Clayton and I spoke about today, make sure you're connecting with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon, everybody.